Okay, I'm starting at the beginning of the refresher, and what I'll do is go through each learning objective that's in there, and I'll go pretty fast. I mean, this is stuff that's really already in your head, and all we're doing is brushing it off and putting it in some kind of an organized framework. Okay, so it starts out, they call it back to the basics. Okay, and these are concepts that apply to accounting as a whole, and we begin with types of companies. Okay, so if you think of a big umbrella, we've got for-profit, non-profit or not-for-profit, and then governmental entities. Okay, I kind of forget about this one all the time, but it's a really big word. It's a big piece. So for-profit, non-profit, and governmental entities. And within the for-profit companies, we can break these down further into manufacturers, merchandisers, and service providers. And one thing that I'd like to point out too is when we think about these, you want to think about what their balance sheet looks like, okay? And if you think about a manufacturer, their balance sheet has different types of inventory on it. It's got raw material inventory and work in process and finished goods, okay? So 3 types of inventory. A merchandiser, though, is more like a big box store and like a Target, and they buy goods that are already ready to sell. Okay, so they just have merchandise inventory. So if you see merchandise inventory, you know you're looking at a merchandiser. That sounds stupid, but you know, some of those questions will bury something like that, and you really have to be sharp to pick it up. And then I put a special one here for government entities, because this includes, you know, not only the federal government, but also states, county, and local governments, and in addition to special purpose entities. And you may create a special purpose entity to maybe build a dam or to do some joint project between 2 homes, you know? So so just remember that they're out there, all right? And then the other thing they talk about are stakeholders, and stakeholders include stockholders, employees, customers, and supplies. And all of these entities have like a quote stake in the business, okay? Is that like a stockholder owns stock in the company and it's an owner, okay? So he has a very direct share. Employees are interested in how the company is doing because it affects their livelihood and their chance for future employment. You know, it's really important. Customers rely on it for particular good and service, and suppliers and vendors might rely on the company for a certain type of income. So there's a fluid relationship among all of these, okay, the way this works. So I don't think, yeah, then the next piece in here is about governing, trying not to make these pieces too long, and then what we'll do is do a problem and, you know, highlight what the characteristic is and then move on. But the last one are governing bodies, standards, and regulations. And even though you sort of know what these are, challenge yourself. See if you could actually say what they are. Okay, because it's one thing to have sort of an intuitive understanding of something and a whole nother one to be able to really speak about it. So the Financial Accounting Standards Board, okay, these are standards for accounting and financial reporting within the United States. Okay, and it applies to all types of organizations, public companies, private, nonprofits. All right, and that's the concept that they use here. I'm going to write this down, is useful information. Okay, that's what we're supposed to provide. And this thought actually came up in the 1980s, believe it or not, useful information. And that's why the income statement got a lot more important to a lot of people. The balance sheet is now, so it switches back and forth. Then GAAP, Generally Accepted Accounting Principles, are principles, standards, and procedures created by the FASB. Okay, so these are the principles, standards, and procedures that are used within the United States that public companies have to adhere to. Okay, and then we've got IFRS. This is a common language between countries, and sometimes it's a surprise to people to find out that the United States is the only country that uses GAAP. Everyone else uses IFRS. Okay, and you can file on our stock markets. You can get on our markets with IFRS generated statements. So it's kind of funny that, you know, that we built this infrastructure, but we won't leave it, you know. And then SOX is still on here, and SOX was created in Sarbanes-Oxley, created in 2002, and it was the real first litigation in a long time that took place, and most of the features of it were targeted toward the investing or toward the financial community, okay? But it's been gutted. I mean, it's a lot of the strength of that has been gone over the years. So, one politician after the next. And then finally the SEC, and the job of the SEC, just think it's a federal agency of the U.S. Their job is to protect the investing public in this country. And what's kind of cool about it is that the SEC is actually governed by Congress. Okay, so if the FASB comes up with a standard that the SEC doesn't like, they can void it. Okay, or if they think that we should have a standard on something, they can write it themselves. Okay, so the FASB isn't really the ultimate decision maker in all this. It really is Congress who's in charge of everything. I'll bet that gives you comfort, huh? Mm-hmm. Okay, so the next thing we're going to do is, well, we're going to do it right now. Let's look at a little bit. We're going to do debits, credits, and journal entries. Okay, and this is Learning Objective 2. And I want to look at this this chart here. This is one way. Now, remember, the one thing you want to remember with our class is that some people are in our class that haven't been in school for 2 years. Okay, or some haven't taken this course in 2 to 5 years. Okay, it could be a really long time. So when they come in here, then they get all nervous, thinking, "Oh my God, I don't know anything." So the purpose of this refresher is to just sort of get you back up to speed and help you relax, because you do know things. You just have to dust it off a little bit and get it more prominent in your head. Now here is one way of looking at debits and credits, and this is the way I do it. Okay, I like this. Not a lot of people do, but here's an image of a big T account. Okay, a big T, and within the T is the balance sheet and the income statement. And on the balance sheet, I'm going to increase assets with a debit, and I'm going to increase credit, or I'm going to increase liabilities and owner's equity with a credit. Okay? That's what they'll do. And the accounts that move around, that have the most activity here, are right up and top. They're operating assets and operating liabilities. Usually, both are short term. Okay, that's where all the activity is. Other than that, it slows down quite a bit. When we do the income statement, I'm going to take revenue and I'm going to put it over here on the same side as owner's equity. Okay, and I'm going to put expenses over here on the debit side, because expenses really are used up assets. So when an asset is used up, it's going to slide down here as an expense. That's where it's going to be. Okay, so this is one way to do it. If you're interested, I'm going to upload a file that has 2 pages of journal entries that are real short, the short entries. But if you have any trouble with debits and credits at all, by the time you finish this worksheet, and it doesn't even take that long, you will be just in great shape and will have no problems with it. Okay, that's enough now.